Well, hi, and welcome to another session of Uncommon Knowledge for Seniors. Today we have Brian Albrich. Brian is a mortgage broker. I've known him for many, many years, and he's with Fairway Mortgage, and they do reverse mortgages. He does regular loans, but he also does the reverse mortgages. And one of the things we wanted to talk about today, especially, is the propensity or the possibility of purchasing a home with a reverse mortgage. A lot of folks really don't know about that, and it's 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 got some tremendous benefits. And uh, I think after you get through a lot of the misinformation about this loan and the misconceptions and what it really is and what it can really do, it's enlightening for a lot of people, and we're going to talk about that today. So, Brian, thanks for being here, sir.
Yeah, I'm happy to be here. Thanks for the invite, Jim.
Well, good. And we're going to put in the show notes all your information to get a hold of you and all that kind of thing. But uh,
Great.
why don't you give us kind of a summary of how you even got into doing these reverse mortgages? What was your
Yeah, well, okay. So yeah, no, I got into the mortgage business in 2002 and did regular mortgages for, most of the time between now and then. About five or six, actually, it was the summer of 2018. I had the opportunity to go back to our corporate headquarters in Madison, Wisconsin, to take a class on reverse mortgages. And I thought, well, worst case, I get to go back and have a pint or two of Wisconsin beer and eat some cheese curds. But it was 3.5 days, all taught from a financial planning perspective. And I thought, oh my gosh, this sounds amazing. It actually almost sounds too amazing, too good to be true. Um, Well, I came back and all the names that were dropped and the books that they referenced and all that, I researched all of this to make sure that the math actually was right. And that the first guy that got published in the financial planning or the Journal of Financial Planning, so financial planners read this stuff. He his name's Dr. Barry Sachs. And
yeah, yeah, yeah.
Barry, when he retired, he researched the the most efficient retirement plan for himself. And his background is a PhD in physics from MIT and a Harvard Law degree. So I thought this guy knows math,
Hmm.
and he proved that even highly affluent people do better overall financially with a reverse mortgage in the equation. Because what happens, and he did some really cool research using the reverse as a non-correlated asset from the other assets that were invested in the market. And he showed that you could, if the market took a downturn, so rather than sell to pay your bills, sell when the market's down, those years he showed to use the reverse line of credit and let the invested funds recover before
Hmm.
drawing on them again for retirement income. So he was the first guy to get published, and that's really got my juices going after that. And I thought, okay, this is legit. I feel comfortable talking to people about this, and then I just really have been doing it full time for the last 5 years.
Well, that's great, because it's obviously you have to manage it as you do with any other kind of investment, and but it's it's just so good. It works so well, and we've seen this over and over and over again, and
Yep.
I think the the biggest thing is getting through all the nonsense about it. There's and I'm not quite sure where that came from because it's funny.
Yep.
Every time I talk to somebody that says, "Well, I'll say something about a reverse mortgage," and it's like, "Oh,
Hmm.
I don't want one of those. A friend of mine got in trouble with it. It's like, oh, what?
Yep.
I don't know. You know, what was it? What was it that really went? No, I really don't know. And so it's
But they're bad.
yeah,
Mhm.
and then you have someone that talks to you for more than an hour or so, and then they realize, oh, they aren't. So
That's
anyway,
right. And there have been some things that have been fixed. These are federally regulated.
yeah.
They're part of they're an FHA loan, and FHA is under HUD, Housing and Urban Development. So that's like the gold standard for all things relating to housing. And so when people say, well, I hear the bank or the government takes your house. And that's just not true.
Mhm.
These are only insured by the government. So, and what that means is you can never owe more than your house is worth, even if we went into the most catastrophic housing crash ever. If you owed $200,000 on your reverse mortgage and your house was worth $1, you are not on the hook. Your kids are not on the hook. The bank doesn't come take the house. Um, so there's a couple things that have been fixed. One of the things that was very problematic early on in the program, decade or two ago, was that if you had somebody that qualified age-wise, you have to be 62 or older to get this. If they were married to somebody, say, that was 52, the 52-year-old or whoever's under 62 had to be removed from title.
Oh,
Which that was problematic if the older spouse died down the road
mhm.
because they were not the younger spouse wasn't on title. That has been fixed. So now if a 62 and a 52-year-old go get a reverse, and let's say they're in it for 15 years and now the older spouse is 77 and he passes away, the younger spouse is on title. And the younger spouse, even though the one that qualified for the loan originally age-wise is passed away, the younger spouse can stay in the home, it says on the note, until he or she is 150 years old. So nobody's quite making it to that, but they're protected if they do.
Good news. But it is good that that's obviously been corrected, because I think that's
Absolutely.
and other things I think that have been.
Yep, yep. The other thing too, they used to not counsel people. Now there's a counseling session involved, and we underwrite them to make sure that they've paid their property taxes and homeowners insurance on time. That it used to be if you're 62 and older and have enough equity, they just gave you the loan. Well, what would happen is people would draw their money out thinking that they never have to make a payment. Well, they didn't have to make a mortgage payment, but they still have to make their property tax payment and their homeowner's insurance payment. And
Yeah.
if they stopped paying their property taxes, there was a lien placed against. And the front page news was, grandma or grandpa gets kicked out of their home because they had a reverse mortgage, when in reality it was they weren't paying their property taxes.
Well, that's one of the things we talked about earlier. I know is the fact that so many folks have say been in their property for 20 years, and the example of like they bought their house for 300,000 maybe 20 years ago, and in a place like Bend here, it's now worth 800 or 900,000.
Yep.
But the property taxes have gone up with that, and so they decide they're going to retire, and boom, they've got this big tax chunk that's just it's just an issue. But
Hmm.
I see the reverse as a way to mitigate that. Be able to say, well, we could do that, and you could still stay in your house. You can
Hmm.
have, have your home, have the investment of the home and all that, but
Yep.
have this chunk of money that you can use to offset your
Yes.
taxes, or buy a motor home or whatever, all those kinds of things. But we talked about downsizing.
Hmm.
Say that scenario where someone is okay, they're in the $800,000 house, and it's on an acre and a half, and they'd rather not deal with it anyway. They'd like to downsize, maybe to say a $500,000 house.
Yeah.
And with the reverse, you could sell the property you're in now,
Yep.
take those proceeds, buy it. Well, you could actually buy a new place in Bend now for about 600,000.
Yep.
Small yard, you just kind of shut the door and go, but a single level, easy to take care of.
Hmm.
You could put that 300-ish down,
Yes.
have a $300,000 loan that you don't need to make the payments on, and have all the cash proceeds which are available to you.
Yeah, I
Problem
actually
solved.
did. I Right, problem solved. I did one very similarly to this. They had some property and they were, in their 70s and they didn't feel like taking care of it anymore. And they did. They bought a $600,000 home in the town that they live next to. They had netted $500,000 from the sale of the place with the property. So on the $600,000 home, they put 381 down and financed the rest with the reverse mortgage. So in that case, they don't have a payment. They do have to pay property taxes and homeowners insurance, but no mortgage. And they were also able to take 120 left over from netting the 500 on that other house and put that with their Edward Jones
Mhm.
person. And that is able to grow and they can tap that. So they were liquid with no mortgage payments.
Well, there's so many folks that I mean, myself included, pretty much got their keister kicked in 2008
Yeah.
when things went south. And I know as Brian Buffini says that if you didn't lose any money in 2008, you didn't have any to lose.
That's right.
But
That's
there's
about
so many
right.
folks are still recovering from that.
Mhm.
It wasn't a pretty thing. And I think for a lot of folks, whether they want to admit it or not, aren't as flush as they thought they were going to be.
Yeah.
And and I think looking at the reverse it in this way with managing it, being able to see the benefits of it and do it is just a tremendous thing, and it gets boggled up in so many different.
Yeah. I think the thing most people, the general population thinks of a reverse mortgage as kind of like, break the glass in case of an emergency. This is, we've ran out of all other options. Let's get a reverse. And the thing that got me excited to talk to people about this was a guy like Barry Sachs that I mentioned at the beginning, because Barry proved that it actually makes sense to get a reverse early in retirement because it gives you more options and generally you do leave more for your kids. You might leave less equity from the home, but your other accounts like your IRA or 401k, those are going to be generally larger
Mhm.
than they otherwise would have been if you had a mortgage payment. So um, there's a case to be made that a reverse should be part of a lot of retirement planning.
And you can say, here's the numbers, here's how it works. This is in your situation, we'll do this, we'll pay this off, and you'll have this much left over, and that's what it'll look like. And then we can buy this house, and it'll
Yep,
look like this, and it'll look like that. And here's the
yep,
numbers for that, and this, very Dick and Jane about the whole thing, and
yeah,
this is how it works, and there you go. And I think once they get to that point,
yep,
it's like, why wouldn't you do this? And
hmm
uh, there's all kinds of regulatory issues and all that kind of stuff that go along with this. But at the end of the day, it's the truth. It's just this is what you can do, and you can enhance your life going forward. How
that's
about
right.
that?
Yeah, at the end of the day, it's just a mortgage.
Yeah.
Everything that people hear about the negative connotations, it's just a mortgage, and
Well, it's an
uh,
FHA mortgage too.
it's an FHA insured mortgage, so you can never be in trouble. You meet your obligations of paying homeowners insurance and property taxes, and you can live there, like I said, till you're 150 without ever making a mortgage payment.
We could talk about this all day. I think that it's because we're
Yeah,
just going to be beating the same
that's right.
same
Yeah.
bell or whatever. But I think any other examples that you've had of folks that have recently done this, and what did that look like? What was?
Well, yeah, I actually sat down with a gentleman yesterday. He's 81. He has a $900,000 home, and he owes 157 on it. And he goes to Hawaii during our winters, and he stays in Bend, during the summer. And he was having to rent his house out in Bend to afford the rent in Hawaii. And he's like, you know what? I could get a reverse mortgage and do a reverse, get rid of that 157.
Mhm.
And so that's saving him about $1,500 a month cash flow. That's $18,000 a year. So now he no longer needs to rent that place. And so if he decides, I want to go home and check on my house in Bend or see my kids, he can just get on a plane and actually go to his own house. He was having to figure out where to stay.
Yeah,
Um,
yeah.
and and on top of that, he, I believe, was going to be able to get about a $250,000 line of credit. He had a roof that was going to need to be replaced in a couple of years and paint, and he can just draw from those. And when you draw, yeah, so let's say it's 30,000 between painting and getting a new roof. That gets removed from the line of credit and just gets added on to what you owe ultimately when you sell your home, but there's no payments on it.
Mhm.
So if you're on fixed income or your income's just not what it was when you were working, it doesn't affect you like a regular loan does because there's no payment required until up to a year after you move out of your home.
But know it and manage it and be aware of it. And this is what it looks like, and this is how it works. And once again, here's the numbers. Here's what that is, and
Yeah,
there you go. You know.
that's right. One thing that's really cool about this, Jim, that line
Mhm.
of credit can never be canceled. You mentioned 2008. There were a lot of people that had home equity lines of credit that year. And when their homes started to depreciate, the banks would call and say, we just froze your line of credit. This line of credit will always grow at whatever your note rate is, even if your home value goes down to nothing. So you can still have a $200,000 line of credit on a house that's worth nothing. So that's pretty safe for retirement planning.
It really is. Yeah.
Yeah.
Yeah. Well, the like we talked about too, the whole thing with real estate has always been, and throughout the years, is that whether you had rental property or whether it's your own residence or whatever it is, you can't really benefit from this equity that you built up over the years, whether it's buying the loan down or appreciation, all those kinds of things. You can't do anything with it unless you sell it. And if you sell it, then you have, or exchange it. If you exchange it, then you can't benefit from the the proceeds because you got to buy another property and all that. And then at the end of the day, when you have to sell your house that you're living in, that's once again is the only way you can benefit from that equity position is to have that money in your hand if you sell it, unless you do a reverse mortgage. And it's like, well, what's that? What's that? How does that look? And then, once again, look at the numbers. But
Yep.
you can get this mortgage where you don't have to make a payment on it, and you get this line of credit, which is going to enable you to even benefit even more.
That's right. It
How
is
about
that.
that?
Yeah, the compounding effect on that line of credit is amazing because I apologize, I don't remember if I mentioned it, but the line of credit grows at the same note rate that is growing your what you owe on the amount, your loan balance.
Yeah.
So if you have $100,000 loan balance, that's growing at say 6.5% today. but your $200,000 line of credit is also growing at 6.5%. So it's getting bigger over time. And the theory behind that is HUD really developed that line of credit to kind of try to keep up with inflation and increased costs as
Yeah.
people age.
Well, I know you're staying on top of this. It's your passion and clearly something that's going to be, I think, with you for the rest of your career. I'm glad you're doing
Absolutely.
it.
Yeah.
Yeah, I've always kind of bristled at the fact where like some banks and mortgage companies don't do reverse mortgages. And I know throughout the years as a wholesaler of a loan product that people had to learn.
Hmm.
They had to learn how to use the adjustables and things like that. It just made them a better mortgage person because they had that was another tool in their toolbox. And I think it's frankly it's the
Yep.
same thing with reverse mortgages. It's like if you can learn this whole venue and you can uh, um, have that in your toolbox, so to speak, and you can
Hmm.
speak to the whole thing. Whereas somebody says, well, I don't do reverse mortgages, so I'm going to try to cajole you into not doing a reverse mortgage, and I'm going to say this and I'm going to say that, and then this, and it's always stuck with me is that how can you be a mortgage advisor? How can you really be in the best? How can you really represent the best interest of your client if you don't represent all the loans?
Right.
Don't understand that, and it's always been something that's nah. So but it's a great thing, and I'm glad you're doing it. And I know Fairway's
Thank
a
you.
leader in this whole thing too with their training and stuff they have. And I know we'll have everything on your website. I know you
Yeah.
have a lot of training videos and things like that, right? The information.
Yeah, absolutely. And there's some great testimonials on there. If they click on my link, that they can go in and see people that have purchased or people that have, paid off things or, you use the money to gift their grandchildren. Just different
Yeah.
ideas and ways that people have used this. And the biggest theme that I take away from all of those testimonials is generally the how life-changing the reverse can be. It lets people actually sleep at night that have been, I've had folks come to me and say, I've done everything right my whole life. I've always paid my bills and all that. And they're 70 or 80 years old and they don't have anything in their savings account because they've been paying their mortgage, but we can make that mortgage payment go away. And all of a sudden they have 20 grand a year extra flowing into their savings account versus going into their house, which is illiquid the way it's set up with the regular mortgage. And all the reverse is doing is creating a little faucet on the side of the house that lets us convert that equity into cash flow for them.
Yeah. And there's a cost for that, but that
Yep, there's
well offset
absolutely a
by the
cost.
benefit, and there's benefits of that. And you just have
Yep,
to weigh those two things
yep.
and do it right. Do it. Here it is. This is what it is. So,
Yep, I asked because of the upfront costs. I do always ask, what are your intentions? Is this a long-term, goal to stay in the home? If they say, yeah, indefinitely, then yeah, those are the people we want to help. If they say, no, I'm moving to Arizona in 18 months, I'd say, go get a home equity line of credit. It's cheaper. Yeah, you have to make payments, but that will get you to where you need to be. But this is a long-term option for folks.
yeah. And buy the home in Arizona with a reverse mortgage and do
That's
that.
right.
But here's
Yep, exactly.
well, Brian, this has been great, man. I think the more information we can get out about this, the better. And it's at the end of the day, it can just help people. And I think that's the message here. And we'll have all your information on the show notes and being able to
Great.
get with you. But why don't you give us your email address, at least verbally here, and phone number so we can have that on the audio and do that. So
You bet. So it's Brian with an I, Brian dot Albrich, ALB as in boy, RICH at fairway.com. And my cell number is 541-771-6175.
Well, Brian, thank you so much for being here today, and it's all good
My
stuff.
pleasure.
Thanks.
Yeah. Thank you, Jim.
Take care.
Okay, you too.
Bye.
Bye.